the buy and hold investing strategy. Is this dead? Does this even work anymore? Watch this video to find out. Hello and welcome back to another video with Mind Money Masters. I'm Cameron, I'll be your host again today as we answer another highly controversial question. Does the buy and hold investing strategy for the stock market really work anymore? Thank you so much for watching. Please remember to subscribe to my channel and turn on notifications to see any new videos that are created. Also, if you feel comfortable, please add a comment in the feed on what you liked and what I could talk more about. It really helps me to understand what you're interested in. Also, just as a point of disclosure, all of my opinions are solely mine and not any form of professional financial advice, as I am not a licensed advisor. Please work with your financial advisor or professional advisor before making any investing decisions. So, today we are going to talk about the buy and hold investing strategy, what it is, and if it really works anymore. But first, I want to give you these two great quotes. One by Warren Buffett: "I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful." Second by Ben Franklin: "An investment in knowledge pays the best interest." I love these quotes not only because they are true, but they offer some incredible insight into what both of these great men used as investment strategies. So, specifically, let's look at buy and hold investing for stocks and mutual funds. I mentioned those two. I'm going to leave real estate out as it's a different kind of investing structure than stocks and mutual funds. So we're not going to talk about real estate investing today. But this strategy, this buy and hold investing strategy, is based upon the concept that the stock market has appreciated in value on average, quote unquote, 8% since 1927. So what does that mean? So there is more on this in the final take, but you have to understand what the average annual growth rate is and what the compounded annual growth rate is. We always hear in this buy and hold investing strategy that a diversified portfolio of stocks, bonds, and mutual funds carried for the long term will make you rich, wealthy, fill in the blank associated with financial freedom. However, the challenge is that we're seeing that's not always the case, that people have held on to these mutual funds, these stocks, and not become wealthy. They've ended up losing most of their gains due to various fees or to sudden market downturns that, quote unquote, nobody saw coming. The other thing about buy and hold investing is it is a very passive strategy. There is not a lot of active management or research on your part. This is something that basically you hand over to someone else and they manage it for you with under a fee relationship, or you just buy something that you've been given a tip on and let it roll out. This is offered by most financial advisors as the best investing strategy, especially with portfolios that they have to structure that are less than 50K. The challenge here is that when you buy and hold, there's literally no protection associated with it unless you're using stocks. There's no protection within mutual funds. Obviously, more on that in my comparative analysis and on the final take. But let's get into why I think buy and hold investing may be dead. It's unrealistic, for one. So consider the market downturn in 2008 and 2009. The buy and hold investing strategy only works if you stick in it and buy at the bottom. So during this time, most portfolios saw 40 to 50% decline. I'm sure you were potentially one of those people who saw this huge decline in your portfolio. Like, how am I ever going to be able to retire or achieve the financial freedom that I'm so longing for? However, you got to remember, some stocks actually went up during this time. There's a link here in my my notes, and I will put the link also in my description that showed these 10 stocks that actually went up during the 2008 crisis. So it's kind of an interesting scenario that if stocks went up during that time, those 2-year times, then, you know, what are we doing wrong? What are we trying to pick? Are we trying to figure out, have we done enough research? What's the story behind that? So this is the other question too. Can you really hold on or buy more when your portfolio is dropping daily 5-10%? So when you sell and get out, you usually get back in at a higher price. Most people sell in the downturn and then get back in when it's already going back up. So you don't necessarily buy at the bottom. Most people sell at the bottom and then get scared. And then as the market reacts and recovers, you end up stuck on the outside and you can't actually be able to make on those gains going up because market timing is impossible. Market timing is impossible. You cannot figure out where the bottom is. There's no way to figure out where the bottom is. This is also part of the reason why buy and hold investing suggests that you continue to buy, and this works if you continue to buy in the market downturn. So you buy at the lows and you buy on the way up. It's this dollar cost averaging concept that has been proliferated throughout the entire financial world, and to some degree it does hold some water. However, there is a book that I do recommend called The 3% Signal by Jason Kelly. I'm going to leave a link for that as well. That's a really amazing book if you want to do a little bit of research, but you don't want to necessarily turn it over to an advisor and you kind of want to do the work. It really takes two funds and you can actually build a successful diversified portfolio with two investments. It's actually a really amazing book. Like I said, I'll have a link for it in the description, but take a look at it. I mentioned earlier the average annual growth rate versus the compounded annual growth rate. So here's the crazy thought. We say the stock market has been achieving 8 to 10% on average returns over the past 60, 70 years. That's actually not really true, or at least it is true from a certain point of view. If you look at the average, where we take 5 years and we say percent return was 12, 20, 11, 10, we take those added up and then divide by 4, that's the average annual growth rate. However, the compounded annual growth rate is a different equation. It takes the end of your time that you're measuring, where the portfolio balance was, divided by the beginning of where the portfolio balance was, to the exponent of 1 over the number of years that you're looking at, minus 1. So it's kind of an interesting little scenario where this is a different equation, and I will have a link as well to that calculation in my description, so you can actually take a look at it. I did an example of this where the average annual growth rate was about 10.4 and the compounded annual growth rate was about 9.1. So what's really true? Probably the 9.1, because that's what we're really looking at. We're really looking at, then this was actually only over 5 years of growth. So if we look at it from an 50, 60, 70, 80 year time frame, that's going to have a lot more fluctuations. I only had one fluctuation where it actually only went down 20%. Everything else was up. So you can do your own math, and like I said, I'll put the description in the link in the description so you can take a look at it. But it's really kind of interesting to see the difference between AAGR and CAGR. The other piece of buy and hold investing, if you're using mutual funds, there's absolutely no way to diversify your risk. You can't. Like, if you buy more mutual funds, it's basically just spreading out more of the same risk. So it's not actually diversifying anything. The only way to actually diversify or to protect yourself, is to get in other asset classes, or if you use stocks, use protection against those. Use options, use put options, use call options. We can talk about that in another video, but that's one of the things that you can definitely use to protect yourself from a huge market downturn. Most mutual funds offer the buy and hold perspective. And if you can't diversify your risk, that buy and hold perspective, you're going to go down. I mean, you're bound to have market correction and you're bound to lose money in the long term. One of the things that I've kind of mixed a little bit of my final take in there, but I want to reiterate, the buy and hold, you have to take into account your actual compounded annual growth rate, not the average annual growth rate. So again, does that 8% really make sense? That's what everybody is kind of pitching, that the market has returned roughly 8% value over the past 60 or 70 years. But does that really make sense? Is it really 8%, or is it closer to 5%? or 6%. And that's not even including inflation and taxes associated with it. That's just talking about potential growth rate. So if we're looking at taxes and inflation with an actual compounded annual growth rate of like maybe 6% and inflation 2%, maybe your actual realized growth rate annually is around 4%, which isn't that great. All of a sudden, that 8 to 10% becomes 4%, and we're like, wait a minute, that doesn't make any sense. Well, that's what you got to take into account, all of that. There are various alternatives to buy and hold investing, or at least ways to generate income and protection on the underlying investment. There's something called a covered call. If you purchase a stock and you sell a call against it, you could potentially make some extra income and reduce your cost basis on that stock. There's also such a thing as a married put. A put is actually an option contract, just like a call is an option contract. The put protects you from a downside. If you buy a put and buy the stock, you protect yourself from a downside risk, a downside fall. A lot of people use this strategy if they've had a massive gain on a stock, a big run up, and then all of a sudden they're worried that the stock might downturn. They buy a put on it. So the other thing too, remember I mentioned, have you considered other assets? So there are 4 asset classes that we've talked about before. Paper assets, which is what I'm talking about here, stocks, bonds, mutual funds. There's commodities, there's also real estate, and there's creating your own business. The other piece is too, I've kind of recently gotten into some cryptocurrencies. Be careful with this. They are highly volatile. They are highly risky. Know what you're investing in. Don't just jump into cryptocurrency because, someone said this particular currency was going up and I got to jump in on it. That's no different than getting on your latest penny stock, because the penny stock can go up and it can crash right back down. It's a pump and dump scheme. Not saying cryptocurrencies are not. I'm not saying cryptocurrencies are a pump and dump scheme. I personally do invest in cryptocurrencies, but I do my homework. I make sure I understand what they're all about, what blockchain works, how blockchain works, what is this purpose of this cryptocurrency, what are they? So do your research. Definitely invest in your own knowledge. Check out that book, 3% Signal by Jason Kelly. And the last thing I want to leave with you here is that the only way to achieve actual financial freedom is to have multiple sources of income. With multiple sources of income, you are truly diversified. Your risk is actually diversified because you have various streams of income. If one goes down, the other one, you have another one that is coming in. So if you have an issue with one, you have another one. That's just common sense. And the wealthy have at least 7, I think 5 to 7 streams of additional income. Now, you can build a business in as little as 30 minutes a day. If you can give your employer 8 to 10 hours of your life, personally, I think you owe it to yourself to create another source of income in just 30 minutes every single day. I have a link to the program that taught me how to build a digital business, and I can get to talk about all these things that I'm super passionate about: stocks, investing, Forex, cryptocurrencies, and I have a digital business on the side. It took me from zero knowledge of the digital world to creating financial freedom, where I can work wherever I want and do whatever I want, whenever I want. Please take a look at the description, follow the steps on the page. Also, please subscribe to my channel and comment on what you liked, what I can improve on, and what would be something that you would like me to talk about in the world of investing, personal finance, or making money online. I really love to hear what you're thinking. Cheers to your success and happy trading.